What's up, guys? We're going to be breaking down the Mega Backdoor Roth in our latest guide on this particular strategy. This is definitely one of the more popular financial planning loopholes that we help clients with at Modern Wealth. It's definitely one of the more controversial tax strategies that is 100% legal and it is out there. So if you're not familiar with it, this is going to be a really great guide to get you familiar with the Mega Backdoor Roth. And if you've already heard about it, then I encourage you to still watch because we're going to talk about some planning considerations to incorporate this into your own financial plan. You do not want to miss it. Thanks for tuning in, guys. If you like today's content, be sure to hit that like and subscribe button so that you keep getting content just like this. And of course, if you need help with your own finances, whether it's with the Mega Backdoor Roth, investing, tax planning, overall financial planning, whatever it may be, reach out to us at www.modernwealth.com. That's modern, spelt with no vowels, wealth.com. So if you're not familiar with the Mega Backdoor Roth, in a nutshell, this is a strategy that could allow you to put in 2024, up to $69,000 in Roth money into an employer-sponsored retirement plan. If you're over 50 and eligible for a catch-up, you can stack that on top of that $69,000 figure. And if you're already doing just a good old-fashioned backdoor Roth IRA, you can include that as well. I mean, so we're talking potentially over $80,000 in Roth money that you're funneling away into your employer-sponsored retirement plan. And the best part is that there's no income limitations with this. So you could be making $1 billion a year in W-2 income, and there's not going to be any sort of income limit with this particular strategy. Again, a lot of people, when they first hear it, they think, how is this legal? How is this a legitimate strategy? But it's all legit. It's 100% legal. It certainly has been scrutinized by Congress, and there has been talks about there should be changes to it, modifications to it, but there hasn't been any solid proposals yet. So if there's any changes to it, we'll make a video on it. But for now, it's 100% legit. And if you can take advantage of it, you should strongly consider doing so. So let's go ahead and break down what it is in case you are not familiar with the Mega Backdoor Roth. The first order of business to see if we can execute this strategy is that you need to have an employer-sponsored plan like a 401k that has the Mega Backdoor Roth feature available. Now, you're not going to be able just to log into your plan, whether that's at Fidelity, Schwab, Vanguard, wherever, and it blatantly say Mega Backdoor Roth eligible, right? Mega Backdoor Roth is just a nickname for this strategy. The more technical term is that you need a plan that allows for after-tax contributions. You need to have the ability to make after-tax contributions. These are not the same as Roth contributions, and we're going to talk about that in a moment. You also need to have that plan give you the ability to do in-service conversions or distributions of those after-tax contributions over to the Roth side of the plan. If you have those two features available, then we're in business and you could potentially execute the Mega Backdoor Roth for yourself. Let's go ahead and dissect this a little bit further. So that after-tax component, right? This, again, tends to get people really caught up because most people think when they hear after tax, they think, well, that's Roth, right? Roth money I pay taxes on and it grows tax-free. That's after tax, right? Let's break it down. So there's generally 3 contribution types with a 401k plan, and you may not have access to all of them. So the most common one is obviously pre-tax. These are dollars that go into your 401k plan. You get a tax deduction on them. They grow tax deferred, and then the money comes out later as taxable, and you report that as ordinary income. There's then the Roth contribution type. This is what a lot of people are familiar with, right? This is where you contribute to the plan. You've already paid taxes on those dollars. Those dollars grow tax-free and come out tax-free. Now, after tax sounds a lot like Roth, but it is not. It is not the same as Roth. It's going to sound a lot similar. So after tax contributions, these are dollars that you've paid taxes on. They go into the 401k plan. You've already paid taxes on it. But the difference is it grows tax deferred. So what that means is, let's say you put in $100 in after-tax contributions, and over the years it doubles to $200. Okay. That $100 of growth, later on, you are going to have to report that as ordinary income. You're going to have to pay taxes on that growth. So if you're hearing that and you're thinking, well, that's kind of a crappy deal. Like, I'd rather just do a Roth, right? After tax kind of stinks. Yeah, I mean, you're not crazy for thinking that. On the surface, after tax doesn't seem like a great deal, but it's absolutely vital to have it for the purposes of the Mega Backdoor Roth, because we can manipulate it and turn all that money that goes into the after tax bucket into Roth dollars. And I'm going to show you that in a second. So for anybody on Spotify video or on YouTube, just on your screen, you're seeing what it would look like on your 401k portal or custodian if you had that feature available. So again, if you logged into Fidelity, you went to go modify your contributions, you would see pre-tax, Roth, after tax, right? If you see the after tax contribution type, then we're in business, right? So be on the lookout for that contribution type in the plan, because if you have that, we're in business. If you have that piece of the puzzle in place, then the next thing that you are going to have to do is you're going to have to call up your custodian and ask, hey, can I convert those after-tax dollars over to a Roth? Can I convert it over to the Roth? Usually it's the Roth 401k in the plan. If they say yes to that, we're in business. You can do the Mega Backdoor Roth. Again, that's the two pieces of the puzzle that you need. You need that employer-sponsored plan. You need to have the ability to do after-tax contributions. And of course, you need to have the ability to convert those after-tax contributions over to the Roth side. So let's go ahead and break down an example to show you how this plays out in real life. So let's go ahead and say that you have $100,000 in W-2 income. You're maxing out your 401k, and your employer gives you a 5% match. So if you're maxing out your 401k with employee contributions or personal contributions in 2024, that would be $23,000. Your employer is then giving you a match on $100,000. That's $5,000 going in to your 401k plan. Okay. So when you combine 23,000 plus 5, you're at a total of $28,000 into the plan. Now, keep in mind, while the employee contribution limit is $23,000, that's what you can personally put into the plan, the aggregate 401k limit for how much you can put in, your employer can put in, and how much after-tax money you can put in is $69,000. Now, if you just caught what I said right there, after-tax dollars are not subject to that $23,000 employee limit. So you can bypass the $23,000 employee limit in this example with after-tax dollars. So in this case, we could fill this 401k up to the brim. We could put in theory, $41,000 in after-tax dollars into this plan, hit that $69,000 limit to fill this thing all the way up. Pretty cool, right? Now, this is where it gets really, really exciting. Now, remember, that $41,000 grows tax deferred, right? You've already paid taxes on that $41,000 that goes into the plan. But if it just stays in that after-tax lane, it's just going to grow tax deferred, and you're going to have to pay ordinary income on the growth. We don't want that. So what we're going to go ahead and do is execute that in-service conversion. This is where that in-service conversion piece is really, really important. So we're going to call up the 401k plan in this example, and we're going to go ahead and ask for them to convert that $41,000 in after-tax dollars over to the Roth side of the plan. We need to go ahead and move it over to the Roth side of the plan. Once they move it over to the Roth side of the plan, we now have $41,000 in the Roth. When you do this, there's no additional tax consequences to you. You're going to get a 1099-R for that $41,000 that you converted over, but there's not going to be any additional income tax owed because you've already paid taxes on that $41,000. So the end result here is $41,000 in the Roth 401k side of the plan, and then $28,000 in pre-tax dollars left remaining in the plan. That, ladies and gentlemen, is the mega backdoor Roth. That is how you do it. But wait just a second. I told you how we could potentially get $69,000 or more when you consider the catch up into this 401k plan. So if we wanted to do that, what we'd want to do is instead of doing pre-tax employee or personal contributions to that plan, we would elect for Roth. We would go ahead and do Roth contributions into the plan. So we would max it out in this example, $23,000 over to the 401k in Roth dollars. So $23,000. We still get that $5,000 employer match. But the thing is about that employer match is that that's pre-tax money. So that pre-tax money, we're going to go ahead and convert that $5,000 chunk that the employer gave us, convert it over to Roth. Here, we're going to have to report it as ordinary income, but we're cool with that because we're trying to funnel as much money into the Roth as possible. And then, of course, move over that $41,000 in after-tax money to fill that plan up to the brim of $69,000 per year, convert that over to the Roth. The end result is that you have $69,000 in your Roth 401k plan. And again, if you do this right and you convert those after-tax dollars immediately over from the after-tax to the Roth, you will have no additional tax consequences if you do it right. One final note on that piece, right, on doing it right with the after-tax side. I've seen people hear about this strategy, elect to try to do the mega backdoor Roth themselves and start doing the after-tax contributions, but then they forget to convert it, right? Do not forget to convert it. Because again, if there's any earnings on that after-tax, because in this case, we put in $41,000, but let's say that $41,000 grew to $46,000. There was $5,000 in growth. Well, now you're going to have to pay ordinary income tax on that $5,000 in growth when you convert all that money over. So you want to make sure that when you are doing the mega backdoor Roth, right, every paycheck, there's going to be a chunk of money going from the after-tax side over to that 401k. You want to make sure that you do the conversion right away. Oftentimes, employers will have a feature, not always, but oftentimes employers will have a feature where you can have those conversions happen automatically. Every time you put money into that after-tax bucket, it converts over to Roth automatically. So really, really cool. If your plan doesn't have that feature, then you're going to have to call up the plan and convert it every single time. A little bit more tedious, but again, I think it's worth it to ensure that you don't pay any additional taxes on those dollars going over to the Roth. So let's talk about some considerations with this. First and foremost, it's highly capital intensive. In this example, we talked about someone making $100,000 doing the mega backdoor Roth. In reality, you probably need to be bringing in as a household, I would say $250,000 and up to do it right. I know that there's, people that will get crazy off, funneling as much money into the retirement accounts as possible and cutting coupons and eating canned beans and ramen. And if that's you, more power to you. But I'd say the average person, you need to be making at least $250,000 and up as a household to really make this worth worth it. Otherwise, it's really, really capital intensive. Now, again, I love the mega backdoor Roth, but it is a retirement only focus. We're funneling a bunch of money away into a employer sponsored retirement account, and ideally not going to touch it for as long as possible and tap it later on for retirement. The issue with that is let's say that you are saving up for a home, right? We work with a lot of clients in LA, San Francisco, New York. These are high cost of living areas that require a lot of money to get a decent first home. And the reality is that oftentimes, even if the mega backdoor Roth is available, we'll sometimes advise our clients, hey, max out your 401k, but let's actually funnel money over to a brokerage account and save for that first time home because that's a big priority to you, right? So you got to balance what your other goals are. The home purchase is obviously a big one, or real estate. Saving for college is an important one. And then finally, if you're someone watching this and you're close to retirement, you got to keep in mind what your overall retirement buckets are. Your pre-tax, your Roth, and your non-retirement buckets. If you're finding yourself having all of your money just in retirement accounts and in nothing else, then, maybe we should look at balancing things out a little bit. So again, I love the mega backdoor Roth, but again, it is generally a retirement only focus and you just need to keep your other goals in mind. Something else to really keep in mind is that you do not want to mess up your match. That match that your employer gives you, whether it's a true up, whether it's a match, whatever it is, that's free money to you. If you've already hit that $69,000 limit in this example, your employer is not going to give you that free money. So you need to be really careful about knowing how much your employer is giving you in true up, matches, etc. Because if you've already hit that $69,000 aggregate limit in this example, you would not get any additional dollars. So don't miss out on that free money. Next, you don't want to over contribute, whether that's with pre-tax dollars, after tax, whatever it is. If you over contribute here and go past these limits, it can be really, really messy to fix. So be extremely careful not to over contribute. Next, the popular question that we get on this, can I still do the old-fashioned backdoor Roth IRA? The answer is yes. You can still do the old-fashioned backdoor Roth IRA and do the mega backdoor Roth in conjunction with it. You'll need to keep in mind, pro rata rules for the backdoor Roth IRA, right? All that good stuff. But if you play your cards right, you can absolutely do both. Finally, if you're a solo business owner, you have your own business, whether it's a full-time solo business owner or whether you have a W-2 job and you do, consulting on the side or whatever it may be, if you have Schedule C income or an S Corp, right? You're a solo business owner. You are generally eligible to establish your own self-employed retirement plan. And if that's the case, you could set up a solo 401k for yourself. And if you set up a solo 401k for yourself, you then can customize the adoption agreement of that solo 401k to allow for the mega backdoor Roth. It's really, really cool. It's something that we help a lot of solo business owners with. That is a separate episode. We have an entire video, an episode on the solo 401k and how to customize it. But again, anybody who has self-employment income watching this, you absolutely can customize your self-employed solo 401k plan to accommodate for the mega backdoor Roth. So there you have it, guys. That is our updated guide to the mega backdoor Roth. It is a really, really cool strategy. It definitely fires me up. You obviously need to be aware of how it fits into your own retirement plan and your other goals. But if the stars align, I think it's a really, really cool strategy. If you need help with your own finances and creating your own tax plan and incorporating stuff just like this into your overall retirement plan, reach out to us at www.modernwealth.com. That's modern, spelled with no vowels, wealth.com. We'll see you next time.